Okay, here we go. Day 2 accounting system build. This thing, I've been thinking about it for 24 straight hours. I'm excited. I got a lot of stuff I want to try here today. If I could delete this countdown here. Okay, it doesn't want to go. So before we get started, welcome in. Happy Tuesday. Um, Remember to check out all kinds of financial models, templates, and tools at SmartHelping.com. You can actually buy everything I've ever built for $9.99, and that's lifetime access to anything I ever build in the future as well. You can ask for a refresh anytime. We'll send you over the zip. I've got stuff for SaaS, real estate models, industry-specific financial models, joint venture distribution stuff, accounting and finance tools. This bundle will be updated with this accounting system if and when I finish it. Human resource tools, personal finance, all kinds of things here. Um, so check it out. Let's send a link out to Twitter. Let them know we're going on this thing. Send a link out to Twitter. Let them know. Sound check sounds good. Accounting system build in Excel part 2. Okay, so that's out. Now this is tough. This is probably one of the toughest things I've done. It's different. Usually I do pro forma, financial forecasting. All right, we'll just minimize that. This is actual, tracking actuals. So let me get into it before I lose you here. Uh, so we're scrapping all this. Let me just clear all this out. None of this is going to be relevant. Okay, we're restarting. Don't need this. Nope, don't need this. Not relevant. Um, Income statement, we're going to have one revenue line, one contra revenue line, and we're going to start there. So here's my goal on how I'm planning to attack this. It's too difficult to have, if we're going to have accounts receivable and payable, it's too difficult to have multiple revenue streams displayed on the income statement. Um, the reason why is because each item would have to also have its own uh, like payment on account line item as well as receipt of payments from things that were sold on account. Now, if you're not selling things on account, you're just customers pay you, you collect the money, and you give them the product, and there's no, they don't have an account, then that's fine. There'll be an option for either way. And I believe that's important to reach as many people as possible is to have a system where you're selling things on account. Some things are sold on account, some things aren't, or nothing sold on account. Any of those situations will be possible with this. But we have to start with revenue, and I have to build one um, line item at a time until the whole thing's built, and I have to also um, make sure I'm accounting for every item I start to build throughout all three financial statements. So balance sheet, cash flow statement, and income statement. So we're going to build one line item at a time is the plan. And that's it. Because I was thinking about a couple different options, like for example, maybe have a selection here in the database that says if it's on account or not, but that's two. I don't want to have two data entries if I don't have to. I'm trying to make this really efficient. So here's what we have. Okay, let's just start from scratch. Here we go. Revenue type 1. And actually, let me clear this out. Um, do we even want to call it type 1? I actually just want to call it revenue or sales. Sales revenue. it needs to be something that's easy to type in. Uh, let's just put in sales. That can really be anything. Okay, so sales is going to come through here. Technically, this could be rent, I guess. If it doesn't have to necessarily be a product you're selling, it could be services, but you're just going to put sales as your line item, and that way in the database we can say, okay, we made sales here. This was a sale. How much? Now, now what I'm thinking is the most if you have like thousands of customers that pay you every month, um, you can bulk those all into one thing and put, okay, here's where all my sales for this. In your description is where you're really going to actually define like how you're going to segment anything if you want to report on segments. But really, for the accounting part of it, we just need to know if it's a sales or not, the amount, the date, and then we also have sales on account. Two options. So sales and sales on account, anything labeled as that is going to be summed up for a given month. It's not going to be, you won't have sales and sales on, it won't be double counted. It's either a sale or it's a sale on account, either one. So, sales, sales on account. We're just going to walk through this. Let's say customer receipts from product X or whatever. Customer receipts from product Y. And let's say in the month you made 6,500 sales for this, and then on account, let's say you did 15,000, whatever the case may be. Okay, so now we have the sales and sales on account system. We also need to put, well, what happens when you receive the money from the sales that were on account? Because we have to know how to decrease the accounts receivable. That's going to be another entry. And so anytime you receive, this would be customers sent invoice for sales, and this would be receive payment of sales on account. And these, obviously, I'm making these descriptions kind of describe what it is, but you would put your own descriptions for these for whatever you're selling or however you want to do it. But the point is, so we have sales, sales on account, and then we have to put, let's see, what's the best label for receiving payments? Sales. Um, let's see, what do we want to call this? Because these are going to be how we identify how this moves through all the financial statements. So sales, sales on account, um, receipts from sales on account. I guess that's as clear as I could make it. So here, let's say we received, and it doesn't have to be just from this month. It could be, if you had sales for the last 5 months and 3 months of those sales somehow you collected on all of them, you'd put that receipt from sales on account, put this number in here. Maybe you got 8,000, whatever the case may be. Okay, so this is the structure we use to figure out revenue and accounts receivable. And I'm actually going to do the formulas. So let's do this. I'll extend this out later, but for now, let's just format this. Actually, this might be a good format. Nope, it's not. Let's give this a good format here. We'll do two decimals. Okay. So for sales, I simply go sum ifs, and I've only got two potential sales items, and these are hard coded, so you can't change the labels, and that's going to prevent errors when you're using this. So sum up the amount if this is equal to sales, and if the date is greater than or equal to start month, also if the date is less than or equal to end of month, C7, 0. Okay, so here are my, and I have to do another sum ifs on anything that was sold on account. And to prevent errors, you can't change those things, and I'll show you exactly how we're going to do this. So we have this. These are not editable. You will not be relabeling these anything. So what that means is whatever your business does, when you collect money from customers, that's going to be called sales. When you collect money or when you make a sale to a customer and they owe you money but you didn't collect it yet, that's a sales on account. When you receive money from customers that paid on account, you hit you it's a receipt of from sales on account. There's no wording changes here. And because I'm gonna have to use these words to do the formulas, and it's not gonna work if the user is able to change these. Now, what you can change is the descriptions, and that's where you can call things whatever you want, because that's not going to matter for as far as the logic that's happening in the to figure out all the math. But these are not going to be able to be changed, and that way you won't have an error as long as you're using the dropdown and all your data is fitting in the dropdown. There will be no errors. So sales, sales on account, receipts from sales on account. Those three, that's it. That's the only labels we can do for categories for collecting money. Okay, so we have this. We need to also say sales is going to include anything that was sold on account. Now we don't care in the revenue about collection of those sales at this point. So sales on account, and we can drag this over. What date did I put for here? Sales on account. So that should be hitting February 2023. Let's update our formulas here. Now I will extend this out for 20 years when we're done, but for now I'm just doing the 12 months. And we'll zoom out of this a little bit. Okay, so there it is. So you've got your sales revenues for these months based on the data. Note we are not counting this in sales because this row is accounting for any sales that have already been accounted for. You see, so what we use this for is to reduce accounts receivable, and then this increases accounts receivable. This number here also will decrease on the cash flow statement. It will decrease based on starting with net income, and then we got to add or reduce any sales made on account. And then when we increase sales receipts from, this one will increase on cash flow because this is not included on the income statement, just the cash flow statement. So let's keep walking through this logic. So we've got total revenue. Let's give this a top thick bottom border. Total revenue. So the next part, let's do, oh boy. So the balance sheet, we haven't formatted anything in here yet. Let's kind of start like, how do we want to start this? Okay. So we'll have assets, and assets will have cash. We'll have a couple things. We'll have inventory, potentially. We probably won't get to inventory today. We might, I don't know. I'm going to try, but I don't know. And we also have accounts receivable. So those are our assets. Okay? And they are Usually receivables within 1 year are going to be current assets, cash, and inventory. But so those are all of the assets that will exist. I'm trying to think if there's anything else. Oh yes, yes. So there's going to be long-term assets like fixed depreciable items. Um, let me. It's been a second. Let me look here real quick. So long. All right, let me just look up balance sheet fixed assets. I just want to see some label examples here. So current assets, cash, notes, accounts receivable, inventory. Yep, that's what I figured. Other current assets. I don't know if we'd have any other current assets. Maybe we'll build that in. Right now, I'm just trying to do bare bones. Um, Investments, long-term receivables. I don't believe that's going to be relevant for this. Property, plant, and equipment, and other assets, including intangibles. So, okay, yeah, this looks completely good. I'm just looking long-lived assets. I've never heard that term before. I'm just seeing a couple formal terms. Okay, so what we can do, and I wish I could get this stupid countdown out of here. Oh, there it goes. Okay, so we can have assets, total assets. Let's put a couple spaces in here because we want to also put in total current assets as its own thing, and this will be just a regular bottom border. Okay, we're just looking at a couple formats. So that, yeah, fixed assets is what we'll label that. Let's put a little accounting indent in here. Oh, it's already got it. Assets here, total current assets, and then we have uh, fixed assets, and then we'll put clear this. Let me just take out all these grid line or these for now. So we'll have property, plant, equipment all in one row. And then down here, we can just do total assets. Okay, so there's everything we're going to need for that, and then we'll do a thick bottom border here. Now I wonder, do I need let me look at a couple other formats. Okay, so this is all the way out, and then you've got here, current, and then you come back out to here for the other ones. Okay, so uh, let's 1, 2, 3, 4, 1, 2, 3, 4. And then you come all the way in for total current assets. Okay, and then you come back out for property, plant, equipment. And then this is going to be all the way in. Okay, now something looks off here. So these are good. Let's put, where do we want to put this grid line? Trying to make this look super professional. And then liabilities will be out here when we do that. I don't need these things here right now. Down here, we're not gonna, I don't know if we'll get into the liabilities today, but I just want to see it visually. So liabilities are the same kind of deal. 1, 2, 3, 4. Okay, so I did a 4 space. And then this is 8, and then back to 4. Okay, these have to be in further. And the reason why you do this formatting is so you can kind of read the subtotals correctly. So we have assets, liabilities, we'll have owner's equity down here. Then in assets, we have we can label this current assets, unbold, but we'll put an underline. Actually, no, we don't want the underline. Current assets, and then there's these, total current assets. This can actually come back out, I think. Then fixed assets is on the same as here. Property, plant, and equipment. And then total assets is all the way in. Let's see. 1, 2, 3, 4. Okay. Now, what do we have for, so we restructured, we're doing one revenue account, one receipt on sales account. We know how it's hitting the income statement up here. We have the balance sheet kind of structured. Cash, we don't know yet. This will be based on other formulas. However, accounts receivable. So we do have an accounts receivable that we need to calculate here. And what that's going to be is the same formula we did over here. Let's get the formatting. Is we're summing up anything that says sales on account. Okay, so those are sales on account. We want to sum up those to increase receivables for the month if the month matches, but then we want to reduce receivables from anything that's been received from sales on account. So now the actual balance of the accounts receivable will be anything new added for the month on account minus anything collected, which is, what do we label that? Receipt from sales on account. Receipt from sales on account. Okay, so now we should be able to drag this over and add the previous month. And now you'll have a running balance of your accounts receivable. Now we haven't done inventory or cash yet. we'll get to that. So there, now let's say in the next month, let's say on, 3/14, whatever the date, you received payments on account. So you do more receipts from payments on account. Let's say you received another 3,000. Now you look at the balance sheet. Receipt from sales on account. We should be subtracting, let's see, did I do my dates here? This plus that. Oh, wait. So yeah, we're summing up anything new for the month plus the previous month. Now, question here is why are we summing up, let's see, summing D if C matches receipt from sales on account. Okay, let's see what's going on here. This should be a 3,000 unless I'm missing something. Okay, why are we not getting this coming through? Summing up D, March 2023. Sum D if C is receipt on sales on account. Receipts to S. Did I miss the S? Yep, sure did. Okay, so let's undo this, get back to the numbers here. So we just got to put an S on this. And here's the main reason why I think it's going to be important to have these hard-coded. I don't want the user having to figure out um, what to label these. So in our validation, these are actually going to be non-editable. We'll just put these in gray. And you simply, whenever the only three transactions that can happen are you make a sale, you collect a customer receipts right off the bat, or you made a sale, you send them an invoice, and you're waiting on the money, and you're receiving money from sales that were made on an account. Those are the only three things that can happen. Now, in your description, you'll be able to put whatever you want, and that's not a big deal. Okay, let's roll this in here. So we want this. Oh, where's our minus? Minus here, and then we want to always add the previous period. All right, so does that make sense? 7,000, 4,000. Let's look at our data. It should be 15 minus 8. Let's put this in January, actually. So we have 15, and then we're subtracting 8 and 3. And then let's say we have some more sales on account in April for 9,000. Just want to make sure the logic's working. So we have 15. We got paid 8,000. That makes sense. Then we got paid 3. So we still are owed 4, but then we made some more sales on account for 9. So 9 plus 4 is 13, and then it's 13. Okay, so this is good. This is making sense. Let's see, total current assets. We can just sum up this. And then this will be some number. We'll get to that. And what I'm doing right now, I'm trying to go line by line in the financial statements and just do one thing at a time. So this will be our total current assets. All right, I feel good about this. This is good. Just bring this out to December. So we're pretty good on our revenue. The cash flow statement. So we have net income. Let's extend this column width, zoom out. Okay. Now, net income is going to come right from the income statement, whatever that might be. Here. And all we've done so far, we actually don't really have anything yet. Except for, let's just zero out everything that doesn't exist so we can just check other logic. Okay, so 0. This is all needs to be formatted. And I think this is the easiest way to build the accounting system is do one line item at a time. So right now we're doing sales, and anything that is related to sales, we'll also have to do contra sales items. Let's see. That's that. That's that. Now this will come through as a negative. These are zeroed. This will be net revenue less cost of goods sold, variable costs. Expenses. I actually had a great idea overnight about how to do expenses, and so we might get into that today. I don't know. We'll see. So but I'll have a way to do expenses on account, receipt of, or payment of those expenses, all that stuff. Here we're gonna go this minus that. We don't have any logic for here yet. I'm just getting the formulas in here. I just want this to be somewhat just working as I add each line item so I can see what the other effects are. Okay, so then we have EBIT minus this, minus this. Okay. Now I have to go to the bathroom. So I will be right back. In 1 second. Okay, back. Sorry about that. Okay, where were we? Um, Revenue. Cash flow statement. So we have income. We want to add back. Actually, we want to reduce accounts, reduce sales on account. And we don't know what that is directly from income statement, so we have to actually sum it up here. So we need to know what was sold on account for the given month. So let's copy that side of the formula, put it right in here. Actually, let's put in less sales on account because we're starting with cash flow based on the net income. And net income includes all sales. Doesn't matter if it's made on account or not. That's counted. So we reduce that here. And so we see, okay, there's where my sales on account. Here's where my actual net income. Now, February and March, we didn't have any sales. Nope, these were receipts sales. Now, if we had sales, we would have to say our sales on account in February as well. We could put this in here. It doesn't have to be in order. Let's say February we made $25,000 sales on account. Okay, so you can see on our balance sheet, whoa, now look, our accounts receivable has grown a bit. And so there's our net income. Oh, shoot. So this is receipt from sales on account. We want to reduce sales on account. So we reduce sales on account. However, the income already includes all the sales that we actually made, whether they were collected or not. Reduce this, and then when they actually get collected, what happens is the balance sheet accounts receivable will go down. Cash goes up. Now let's think about this. So this is why I'm only doing one account item at a time because it's complicated. So this has everything in it. Reduce sales on account. What are we doing on the cash flow if we receive payments? I guess that'll increase cash here. So on the balance sheet, cash goes up, receivables go down. So that's going to raise that. This will go down. Yeah, I think that's it. So we actually have to have less sales on account. Now hold on. We've actually so on net income, we have sales on account is included in here. We reduce it out and then add it back when it actually is collected. So add back receipts from sales on account. And here we just do receipts from, and let's see how receipts from sales on account. And that's going to be a positive. And you can see we're going to do similar logic for like, I'm going to do inventory. We're going to do like, we're going to have all kinds of logic for inventory, payments, um, made on account, and that'll have to do with payables. But right now, let's focus on this. So, all right, sum this whole thing up. So net cash flow from operating activities, all the account stuff we zero out. If it comes in on account, we zero it out. When it actually is received, we add it back in. Balance sheet, now the cash is going to equal the cash flow in the change of the ending period plus previous balance. I'm just trying to hit all aspects of each potential line item, and that's how I think we go through this the easiest. Okay, and then I haven't done anything with any of this stuff yet. We'll have to do like account entries for like CapEx, debt, all that stuff will have its own entries. So finance activities, invested activities, these are just summed up. Then let's see if we balance based on the current entries that exist. Kind of curious here how close we are. That plus that. Okay. These are 0. Oh, I don't even have liabilities or owner's equity in here yet, actually, so I guess we could start putting that in. There's just not going to be much to it yet, but might as well put it in here. So liabilities, owner's equity. So for now, these are all zeroed out. And there's no items yet, so but we'll put like current liabilities, and those would be accounts payable. Oh wait, what happened here? Accounts payable. Don't need that. Total current liabilities. So we haven't done anything for this yet. We'll do long-term liabilities. This would be like debt, long-term debt, loans, total liabilities. We're going to see if we balance here. So this is all zeroed out for now. Okay, get this all formatted the same. Owner's equity. All we have now for owner's equity would be retained earnings, common stock, and we'll get more into this later. We'll put some fillers in here. Total owner's equity. The key is as I continue to add line items, so right now we've got everything built for sales. The income statement's working as it needs to for all the sales items. The balance sheet should be working. The cash flow statement should be working. So we should be able to see everything that's going on with sales is the goal here. And then we'll just continue to add line items or transaction types into the system until it's done. Where was I? Oh. So retained earnings is simply going to be net income. And we take it right from here. And then it's that number accumulated over time. Now this should balance. This should balance. We're going to find out though. It looks like it is. It does actually. So total owner's equity and then total liabilities plus owner's equity, total assets, check. So those should always be equal. So if we add up total this plus liabilities, we get 21.5. Our total assets are here, and they match. Okay, so I mean that's a good sign. That indicates our logic is correct so far. We haven't done much. We've just done sales. So let's kind of play with this a little bit and see. So let's say, in June 2023, sales, we'll just put, let's say make another $150,000 in sales. No on account, they're just completely received. So how does that affect income statement? Well, there's the revenue, net income, balance sheet. What happens to cash? Well, you can see it went from 17.5 to 167.5 there in that month. No change to accounts receivable. So our assets just went up. Our net income went up, so retained earnings, so that's still balanced. And on the cash flow statement, we just had net income here. Nothing was on account, so there's no crazy stuff. Now let's say in August, I'll try to make this really explicit. So here, sales on account, item XYZ, whatever, let's say. Now, the reason why I want to do this in Google Sheets is because when you start typing in something in Google Sheets in a dropdown, it will start populating for you. This is only doing it because I've already written it above. Let's say we have $300,000 in sales on account for August, and let's say we don't actually collect any more sales on account until October. And received payments on account. So now we do receipts from sales on account. Let's say we received 125,000. So we can really see how this is going to flow. So income statement, that 300,000 recorded as revenue when it hits. So it's increasing net income, or it's increasing the balance sheet retained earnings. But look at our accounts receivable is up. Cash has not changed because remember we made the sales here. We made sales, but we didn't collect any because we collected some, but we didn't collect a whole bunch. So it's sales on account. Now here, accounts receivable went way up because we just made all those sales on account for 300,000. And you'll look in October, they're collected. So look what happens to accounts receivable. It's up here. It goes down when we collect. And look at the cash. The cash goes up when we collect. So that logic is working great. And you can see we still balance here. And on the cash flow statement, here's what's actually happening. And let's give these some borders so we can really tell what line's what. I don't know if I like the borders or not because it kind of makes it look, I don't know. It's easier to see though what line is on what, so we'll just keep it for now. It's no big deal. And so there, I mean, I think we're good on revenue. I think we got revenue down. Um, there's only three options. And what I did, guys, I consolidated it down into just sales, sales on account, and receipt from sales on account, instead of having like four different revenue items, because then I would have had to do four, basically multiplied all these things by four, and you'd have to remember what to do. Instead, if the person's entering the data, you can enter it on a monthly basis or whenever you want to record your sales. You don't have to record every single little sale unless you want to. But I would suggest, if you've got thousands of customers, that you bulk them together in total monthly amounts and put, here's how much I collected, here's how much was on account, here's what I collected from sales on account, and that will all populate your income statement correctly. Okay, so let's go on to the next line item. We got one line item done. Um, yeah, I don't know if I like these all boxed in like this. Hey, yeah, no problem there, my ink. Good to hear from you. Good to hear from you. I don't get much talk in the chat, so it's nice to see. um, yeah, we're just grinding it out here. I think this is going to be, I've had some good feedback on this tool. I've had a lot of positive feedback. I had one person say that they don't think there's a market for it, and I'm like, trust me, there's a market for creating financial statements in Excel. Based on a transaction log. People will use this. So, all right. I mean, so that's it. We've done all the logic for revenue. Now let's move on. What's the next part? Contra revenue. So this would be accounting for things like refunds, um, chargebacks, stuff like that. So what you would do, you could again do it. Have I worked in any company? Well, I did out of college for an auto repair company, and I handled their transfer of their financial statements and tracking from one software to another, and it was really difficult because I was just learning everything. Um, but yeah, that's the first actual task I had at my first job, and this was about 11 years ago. They were transferring accounting systems. So I had to figure all that out and work with their CPAs to do that. But other than that, he sold his company, and then ever since then, I've just been on my own. I just started doing stuff on my own for finance and accounting. Now, mostly I do pro forma work and trackers, but a lot of the stuff I do has to do with accounting anyway. So I figured this is going to be a really good tool I can point people to, because a lot of people try to use the pro formas as their accounting system, and it's not really built for that. So now this tool is just going to be out there. Yeah, you can always email me. Let me type it in here. You can always email me. Um, okay, so Contra Revenue. We're going to do a new item here, and this is going to encompass anything that's a refund, receipt, etc. And all we're going to do is label it as Contra Revenue, so it's easy for the person to input. So now I can put, let's say we had, and over here you could actually label what it is. So we could say, refund, chargeback, whatever. These would be all contra revenue items. Let's just say they happened in February and March, just random numbers. And let's say we had a couple, 2,000, 1,500. So now so notice all of these amounts are positive, and I'm doing all the logic in the financial statements to make them correct. So contra revenue, we have, we'll just put in here refunds, receipts. What's other examples of contra revenue? Examples of contra revenue items. Returns, sales allowances, discounts. Now, if you had discounts in there, I guess then you'd have to assume your sale is the full amount. But I feel like if you made a sale, you're just going to record what you sold it for after the discount. But I guess okay, so sales discounts. I'm just trying to make some labels here. Yeah, sale. Yeah, that okay. So this is just a pretty common term. So refunds, receipts, discounts, and so that's going to be a negative number that's coming out of here. And we simply go equals negative, and then anything that says, I believe I titled it Contra Revenue. Let me double check. Contra Revenue. Because I want to keep these account categories very simple. So it's just kind of giving the direction on, what without too much, clutter. Um, okay, so here's Contra Revenue. Let's make sure this is working right. That. Okay. Now, Contra Revenue, I don't believe we need to go anywhere else. It's just like an expense. It doesn't have a double side to the accounting entry. It's just affecting um, net income, which is going to reduce. It's going to reduce cash flow from operating activities, but that's already in this first line item here, which is net income. And it's going to reduce. So this is, in essence, this that ends up reducing cash on the balance sheet. So balance sheet. So cash is going down, but also retained earnings is going down. So if we had, let's look at here. Um, let's say in June we had $150,000 in sales, but what if we also had a bunch of returns? Let's say, $45,000 of returns. Well, now you can look here. So June we got, those were our sales, returns comes back. So now on the balance sheet, our cash is actually going to be um, based on the net income there. So that's lower. Retained earnings is lower. Doesn't affect accounts receivable at all. And yeah, so that's a pretty easy line item to do. So we've done sales, revenues, refunds. Well, put returns in here too. So whatever you put as contra revenue is going to reduce revenue by that amount for that month, whatever it might be, and that just flows through to net income. All right. Cool stuff. Now, what do we have next? Well, we've done all the logic for revenue, accounts receivable. Um, let's see, what do we want to do next? Let's keep going here. We might go for a couple hours today. I don't even know. Just gonna do as much as I can. Okay, so cost of goods sold. So this is a good one. Now, for cost of goods sold, there's two options. One, you have cost of goods sold for inventory only, meaning let's say you buy cars, you sell the cars, your cost of goods sold is going to be the cost that you paid for the cars. So that has to come in here. Now the person entering the data is going to have to enter, let's say, in June, no, let's say in August we had $300,000 of sales. So we go August, let's say 2023. Let's say we did cost of cars sold. Now, what are we going to label this? Well, we need to fill our drop down in. So this is going to be cost of goods sold dash inventory. Actually, I don't even want to put the dash. So whoever's putting in the data entry, we want them to be as simple as possible. So let's just go inventory. COGS inventory. You could enter it here. So this is going to reduce the value of inventory. Let's say it's 20,000. It's going to reduce the value of inventory. It's going to reduce net income. So you have retained earnings going down. You have the balance sheet cash going down because it's running off of net income from operating activities. Actually, no. No, 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 no. You do not have cash going down. When you buy the inventory, that's when the cash goes down for this, which is a different entry, which we'll do. But cost of goods sold is going to hit here, and we're going to do two options for cost of goods sold inventory and non-inventory items. Non-inventory is just going to be cost of goods sold, COGS. Again, we're trying to make this as simple as possible. Okay, so here, this will be anything in the statement that says COGS inventory. And that's going to be a positive number. It's normally a positive balance. The only reason we have contra revenue as a negative is because it's like a negative positive value. But here, cost of goods sold, so 20,000 will be negative or positive, and we will be reducing that off of net revenue. Okay, so inventory, and then the other effect of cost of goods sold when this goes on is we go to cash flow. We need to add back cost of goods sold so we don't double count it. So we're adding this back. So that's fine. Balance sheet, we have inventory here. So this is going to be a couple calculations, but I can say this inventory value is going to be equal to, well, we don't even have an add inventory yet. So let's add that in too. So we want to do inventory purchases. Now note, this is also going to have to be inventory purchases also has to be a couple different accounts because we have when you buy the inventory and then when you actually pay for it if it's on account. So we have inventory purchases. Now direct inventory purchases are just assumed. Let's think about how we want to do this. So inventory purchases. Do we need two? So inventory purchases on account. And then the other side of it would be payments. Payments for inventory. Because you could buy it on account and then pay it over time, potentially, or you could buy it all at once, which would be this. Either way, the inventory purchases or inventory purchases on account, both of these are going to increase the value of inventory, and then it only goes down when you have cost of goods sold inventory going out. Then payments for inventory is going to reduce cash flow, but that's not going to go anywhere else. And then this is actually when you pay from paying on account. And then, oh, well, also you've got accounts payable. So anything purchased on account is going to increase accounts payable. So there's a lot going on here. Let's try to distill this into something that makes sense. Let me get a date in here, a couple of these entries. So let's say March, let's say buying inventory. We'll do a couple of these transactions. So let's say inventory purchases direct. Let's say it's 75,000. Let's do also buying on account. Let's say you bought 20,000 on account. So what this means is you've paid anything that's just called inventory purchases. That money goes out in the month you put here. Anything that says inventory purchase on account does not go out at all, but it increases the value of inventory, but also will increase accounts payable. And then when you do the last one, payments for inventory, we got to actually call this payments for inventory on account. That will reduce accounts payable and reduce cash. So you have assets going down and a liability going down, so it will always balance. What did I call this? Payments for inventory on account. Okay, so let's look at this. Does this make sense is the question. I guess, yeah, because you can buy inventory immediately and pay for it right there, or you could buy it on account, pay for it later. So let's handle the first one first. So buying inventory directly, uh, we go first, so that's not going to affect the income statement at all. It will affect the balance sheet, so we want to say this is going to be adding anything that says, let me look at what these are called. Either of these two, buying it on account or purchase, will increase the value of inventory. So inventory purchases, we have that. And then we also want to add inventory purchases on account. Okay, let's see if I typed in the names right. So 95,000. Okay, that makes sense. Let's say we bought some more in January. Whoop. And this time we bought a little bit less. Okay, so now we go to the balance sheet. We have inventory going up because we bought it. And this would be the month. This is all month ending balances, by the way. So we have inventory going up. The next month it would be this amount plus whatever the previous month ending balance was. And then minus, now here's where we do a minus, and let's put this at the end. So we do subtract cost of goods sold inventory. So any cost of goods sold, that reduces the value of inventory. Let me make sure that's what I called it. Yeah, cost of goods sold inventory. Okay, cost of goods sold inventory, perfect. And then we can stick that over here as well. And then we just simply add at the end of it the previous ending month balance. So there's our inventory over time. So we buy 75, we have it. We buy more in March here, and then in this case we've sold 30,000. We had cost of goods sold 30,000 in August, which would be, well, wait, 20,000. Yeah, 70 to 50 is 20,000, which would be this. So that's the first part of inventory. Looks good. That all makes sense. So you can account for buying inventory straight up. You can account for it buying for it on account, and then paying for that inventory on account. Now so that's the balance sheet. I believe that should cover everything there. Let's look at the cash flow statement. So here we have to reduce purchases of inventory. And that's, again, not hitting the income statement at all. So we don't have in net income. Reduce payments of inventory, not purchases, payments, whenever you actually paid. So when are payments happening? Well, it would be anything labeled inventory purchases or inventory or payments for inventory on account. Those two are when cash actually leaves. So we want to add those two and there'll be a negative amount here. So reduce payments on inventory. So we have this. We have inventory purchases and then also inventory purchases on account, I believe I called it. Inventory on account. So, and then we had another 95 in March. Let's make sure that's working. Okay, it looks good. So this is when actually the inventory is going out. Notice we've added back. Well, no, we haven't done that yet. Oh yeah. Notice how we're adding back cost of goods sold inventory. So anytime we sell inventory, or anytime we make a sale, we're putting in, if it has cost of goods sold, that cost of goods sold is hitting net income. But the actual cash effect is here. So this is the cost, and again, these numbers don't make sense as far as like when they're happening, but the fact is they're balancing out. So like if I have these cost of goods sold hitting every month for inventory when I sell stuff, we have to add that back into net income because the actual payment that's going out to that inventory is happening here. So we don't want to double count it. So the net effect of these two is um, you should end up seeing a net effect where these zero out, and then the net income is actually what ends up, or the difference is what you actually see, which is your actual cash going out for inventory. Or the other way to think of it is this zeroes out what's happening with the cost of goods sold in inventory because it's a non-cash item, and then all you have left is the cash going out for inventory. So that all needs to make sense, which it does. Um, okay, so we have inventory, add back cost of goods sold. This is fine. Our balance sheet still matches. That's great. You see, we have a negative cash balance here um, because we've bought all this inventory. We haven't had any cash influx. Now, we will have other items like loans, equity investments, all that stuff will be a part of this and be able to be entered. What's going on, guys? Welcome on in here. We're building this accounting system. It's pretty fun. My new approach from yesterday is simply make it simple. So what I'm doing is building logic for each of these types of, so like for sales revenue, we have three things that could happen. Direct sales, where you're collecting receipts, sales on account, and then receipts from sales on account. And what I did is I built all of that through the financial statements. Then we had a contra revenue item, then we have cost of goods sold and inventory. All of this logic we've got built. I believe this all is good to go at the moment. Um, let's just look here. So we have inventory items, cost of goods sold. Inventory going up and down based on, let's see, what are we doing here? So we're adding inventory purchases. We're adding inventory purchases on account. We're subtracting cost of goods sold inventory, and that's the balance. Okay. So the good thing is all of this logic exists in the database, and we are balancing, and that's a good sign. So our check is good to go. We have every possible entry that can happen. Uh, I mean, this is great. I mean, I love making progress. Yesterday was kind of like thinking about it. I spent literally 24 straight hours thinking about how to do this, and this is the way that it's going to work. Um, okay, so what else do we need to do today is the question. We've got, let's work down the income statement. We have sales, we have refunds, this. Now, cost of goods sold, or potentially, I don't know if I want to call this variable costs. We're just going to put non-inventory cost of goods sold. So this would be anything like, let's say, Amazon Web Services, if you're a SaaS company and you need to service, to provide your subscription service, you have to pay for hosting, stuff like that. So those items happen directly one time here, so they reduce, the journal entry is the cost of goods sold goes up, which reduces net income. So that reduces retained earnings. So equity is going down. You also have a decrease in cash to pay for these things. Now the question is, can you pay, like, should we have a cost of goods sold on account? Probably yes. Let's say, I don't know if Amazon does this, but if they do terms like 30, 60 days or whatever, then technically you incur that expense in, let's say, February, but you pay for it in March or April. So yes, we do need to account for that. So we'll do, so we have costs. Let's try to keep these in order. So we have sales, contra revenue, cost of goods sold, and then we'll call this non-inventory. And we also need to do, gotta make sure I didn't lose anything. Cost of goods sold inventory. Okay, and then let's shift one more down. So we have cost of goods sold, non-inventory. And now we're going to have some accounts payable. Oh, shoot. We didn't do accounts payable for inventory purchases on account. That's completely okay. So hold on, we need to do that first. Cost of goods sold, non-inventory on account. Okay, let's look at this. Hold on a second. Let's see. So if we buy, let's say we buy inventory. We bought inventory here in January. We bought 15,000 on account. Let's zero this out for now. Let's see here. So we're buying inventory. Inventory goes up. Accounts payable. And man, we're going to have a lot of payable accounts. Okay, it's fine. So accounts payable should go up. But then what's the offset? Right, so inventory goes up, liabilities go up. What am I missing here? Because we haven't paid some of this inventory. Let's say, we're paying this later, so this is on account. We owe this. Our payables are now rising. Let's see. Well, let's put the entry in here and then think through it. So, shoot, I don't. Okay. Okay. Accounts payable. Can't believe I forgot about that, but it's a good thing. So here we need to put anything that is inventory purchases on account, right? It's going to raise this liability. So we've got two purchases here on account. Now we're out. So what did we do wrong here? We did something wrong because we're unbalanced here. So let's think about this. So I buy inventory, balance of inventory goes up, liabilities go up because it's on account. Then when I pay for that inventory, liabilities go down. So we need to also subtract out this, and we need to subtract out, I think I labeled it payments for inventory on account. I believe. Let's look at that. Yeah, payments for inventory on account. Okay. So there's that. And then again, we also want to add the ending balance. When this is all done, I will make this go out for a period of up to 20 years as well. 15. Okay. Now, what is our other entry? So we've got payables rising. We have inventory rising. What else did we do here? Reduce payments of inventory. That has to happen. Hmm. Well, this is the puzzle. So we're definitely missing something. I'm trying to think about how this is supposed to flow. So cash is going down only when we pay. It's not, there's no effect. All right, we're going to actually zero all of this out. And let's do all this for, let's do January. Let's do buy inventory on account. Let's do a really simple transaction. This is the easiest way to figure this out. We got to get out, reduce all the other stuff so we can clearly see. So we're doing inventory purchases on account. Let's say we buy $20,000 worth. Okay, we haven't paid anything out yet. Then let's say in February, pay inventory. We're going to pay this off. So we have this item, and let's say we only pay 15,000 of it off. Okay, so let's look at everything. Nothing's happening on the income statement, which makes sense. Balance sheet. I think I figured out. So balance sheet, this 20,000 shouldn't be there because it's on account. You're buying it on account, so there's no cash. So reduce payments of inventory. Here's where I must have double added it. So I did inventory purchases, which is correct. But I also subtracted inventory purchases on account. That was wrong. We don't need that because it's on account. It's not affecting cash flow. So that's a situation where I balanced, but I balanced on the balance sheet because I did the wrong entry on reducing payments of inventory. Now, when I actually pay this, we should see a negative number here. I know what I did. Let's actually undo this, go back to the 20,000. So this 20,000 is not supposed to subtract inventory purchases on account. It's supposed to subtract out inventory. Wait, what did I label it? Payments for inventory on account. Payments for inventory on account. And now we should be all set. Payments for inventory. Man, this thing is probably worth thousands of dollars. I don't know if I should really just be charging $45 for this thing when I'm done with it. There's so much cool logic in here. Okay. All right. So now that's when the money's leaving. Ah, there we go. Now look at. So here's our cash balance. It's negative here. This is when we actually pay the money out. Inventory goes up here. Inventory doesn't go down until we actually put a cost of goods sold inventory entry, so that's fine. Total assets. Now here's our payables. Look at this. Our payables are we owe 20,000 for the inventory on account. We paid 15,000 in Feb. Now we only owe 5. And then it doesn't affect retained earnings or anything else. Okay. So that is great. That works. Now what was I just about to do before that? Cost of goods sold for non-inventory items and cost of goods sold non-inventory on account. So these two, one's going to do a accounts payable item, and the other's just going to be a entry that hits cash right away. So how do we do that? Well, let's see. Let's clear this out and it's easiest just to isolate one at a time. So here, let's say we have we're going to enter, we paid for something that's considered a cost of goods sold non-inventory item. Let's say we pick our entry, which cost of goods sold non-inventory. Let's say we paid Amazon $2,500. Now let's also say in January we had on account. So here we accrued some expenses, let's say $5,000 as well in January, and these were cost of goods sold on account, so we're not paying it right away. And then we have to say in, let's say, March, we have nice terms here. We have payment for cost of goods sold on account. So you're paying for these cost of goods sold later. Did I put an entry for that? No. So let's add that in. So we have cost of goods sold on inventory, cost of goods. Make sure we didn't lose any of these account items. Payments for cost of goods sold non-inventory on account. So it's actually really important that I don't lose any of these entries because I've built logic around every single one of these. So let's make sure we've got inventory purchase on account, payment for inventory on account, cost of goods sold, cost of inventory, payment for. So this is what we're doing now. So we've got straight up buying here, buying on account, we're paying that amount. So these are our inventory, and then we've also got cost of goods sold and inventory here. Now, what's the straight up cost of goods sold entry? Did we even do anything for that? For just COGS? I don't think so. Is there anything here that's just summing up COGS? I don't think so. Just double check. So that we don't need, I don't think. Let's double check here. No. Okay, so that's fine. That's great. We can remove this. So we've got our inventory logic. We've got inventory depletion here. Buying. Then here we have non-inventory cost of goods sold purchases or payments, payments on account, and then or expenses on account and then payments for those expenses. So if I do that here, so non-inventory, what I have to do is let's sum up, make sure this is working. anything that says, what are we calling this? COGS non-inventory. Okay. And then we also want to sum up. Now if the expense is accrued, it does need to hit the income statement on this date, so we have to also add cost of goods sold non-inventory on account. So on account, so this is a total cost of goods sold hitting here. Now we have 75 and 5. Oh, this has got to be payments. Now, once we're all done, we're actually going to have to re-go through every single type of transaction and make sure we have all the right accounts for that to happen. All right. So here's cost of goods sold happening. It's an expense. It hits the cash flow statement. Now the question is, we actually have to add back, where do we want to put this? Right here. We have to add back, cost of goods sold, non-inventory paid on account. Because that cash is not going out yet. And then we'll have to put here, reduce payments to cost of goods sold non-inventory. Okay, because and we can just enter. So these add back cost of goods sold non-inventory paid on account is just this. Okay, so right, there's no cash happening. There's no change of cash. But we want to reduce it, so we're adding back, but we do want to reduce when it's actually paid. So that would be if it says payments for cost of goods sold inventory. So when we're actually paying that cost of goods sold, whenever we do pay that, we have to reduce the cash by that amount. Dang it. Apparently I can't copy this. So payments for cost of goods sold non-inventory on account. Payment for cost of goods sold non-inventory on account. See if I typed that in right. I did not. Is it payments? Yep. Okay. So there's the actual expense hitting. It does hit the income statement, but on the cash flow statement, we add it back because it didn't actually go out, and then we pay some of it here. Now it hits cash. So it's on the income statement correctly. It's on the cash flow statement. Now for the balance sheet, this is a payable. So we're going to increase. So this is another entry here for this, and yeah, this is going to get complicated. So we add inventory purchases on account. We reduce payments for inventory on account. We add, and you know what? Hold on. I'm going to make a couple entries here. So we're going to have inventory payables be its own thing. Then we're going to have cost of goods sold payables. And because we're going to have this, and then we're going to have the other regular operating expense payables, which I'm going to separate into 3 categories. And I don't want to have, like, I don't want to have too many, but I also don't want to have, like, 18 sum if formulas in one thing. So inventory payables, cost of goods sold, then we'll have one for, like, general OPEX payables or other expense payables. All right. Oh, wait, this seems to be indented more. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. Reduce this. 1, 2, 3, 4, 5, 6. Okay, want to make sure these are lined up. So, okay, so this, did I add that to this? Inventory on account, payments for inventory. Okay, no, that's fine. So on here, we're going to do the same exact logic, but it's going to be for a different account. Same logic though. So it would be cost of goods sold on inventory on account, increases it. And then what would decrease it is payments. Payments for cost of goods sold non-inventory on account. And then we add the previous. Okay, now hold on. Why is this still 5,000? So this comes right out of cash flow in that month. This increases payables, but then we pay for it in March, so it should go down. So summing that minus pay. Oh, I probably didn't put it in right. Payments for cost of goods sold, non-inventory. No, I think I did it. Payments for COGS, non-inventory on account. No, that's right. That's right. So what happened here? Let's zero this out. Let's see why we don't have a value decreasing. No, it is there. It is there. Undo. Let's take out this. Okay, so we have this plus here. Okay, so what was, did I have a what's the difference between this? Look at this. This formula is the exact same as this here. I mean, nothing's changing. How is that? Why is, oh wait, that's right. What am I doing? That's right. It should be, okay. All right. So this here, this doesn't need the plus. Now let's check this again. So we go back to our accounting thing here. Let's say we do this again in June and July. So let's say in June, we buy we pay for some cost, or we incur expenses on cost of goods sold non-inventory of, let's say, 15,000, and then we pay for those items that are considered cost of goods sold in August and we pay almost all of it off. Let's say we pay 12,000. Let's check the statements and see if that makes sense. So 15, yep, goes up here, goes down here. Now we are off on our, let's look at the cash flow statement. So did we do both of these? Reduce payments to cost of goods sold, non-inventory. So this is the payments, 5 and 12. That makes sense. This one and this one, but we need to, and we're adding this back. What am I missing here? So net income zeroes out. We pay for it here. Now in March, we pay for it. So that's negative. That's correct. This goes down. Why is retained earnings minus, oh wait, no, that's right. That's unchanged. So here we're out by 2,500 somehow. So it's half, though there's the issue with the accounting. Let's look here. If we paid out 5, cash goes down. We also reduce this. So this goes down. Down, down. Unchanged. So how do we have a variance here? $75. Let's see. And then also we have a variance here at 15 of 17.5. Okay, so something is not right. Let's look at the net income. So here's the cost of goods sold hitting in total. So we've got 22.5. Uh, hold on. Cost of goods sold non-inventory that was not paid on account. So this 2,500 also has to be added in here. Wait, it is 75. So that's these two. Then we pay, then we accrue on account, and then we pay. Oh, well, what are we missing here? This is why we're isolating each account, because if we were trying to do this with everything else going on, we would not be able to figure it out as easily. Well, let's look at this first one. So cash flow statement, we've lost 7,500. Is that accurate? Yes. Even though it's paid on account or not, it still hits in that month, so we're down 7,500, so that makes sense. We add it back because no, 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 no. Okay, here's where we got the issue. Okay, got it, got it, got it. Um, we only want to add back cost of goods sold, non-inventory paid on account. We only add back if it was paid on account, right? Because if it was paid on account, we actually didn't pay it out yet. But if it was paid right away, we did. So 2,500 of it we did. So we did have a $2,500 negative here. Now, so cash goes down 25. This is adding cost of goods sold on inventory. Correct. minus, right. Okay, so what are we missing? Let's just do one of these. Let me remove this here. Let's just do one transaction. So if I buy inventory on account and I pay for some up front as well. So here's, or no, sorry, non-inventory cost of goods sold. So I pay for something that's considered cost of goods sold. Let's just zero these out for now. So it's $2,500 loss. Income statement, we have $25 loss. That's fine. Okay, we check out there. That matches. We've got $25 going down, $25 going down. Now, okay, so that makes sense. Now let's say let me just zero that out because we know that's working. Let's say now we pay or we incur that expense, but now in this case, let's say it's on account. So let's say we were paid Amazon Web Services, we got 60-day terms. So we incur this expense here, 2,500. Income statement still 2,500 down. That makes sense. Cash flow, nothing's happening because it's being incurred on account. Balance sheet, here's where we're off. Okay, here's where we're out. So if we pay, I mean, if we pay, we didn't pay this expense yet. So our payables is up. Where else is this hitting? Oh wait, payables is up, retained earnings is down. What's my other entry am I missing here? We have no asset. We're accruing a bill. Let's see. So payables, the expense payable goes up. Cash doesn't move. What's the other entry here? Am I missing something? Retained earnings is down. Oh wait, no, this makes sense. Here's oh man. It was all correct the whole time. I just hadn't added in. Okay. Oh my goodness. When these things happen, you've been going too hard. So we need to add this. This was a new item we added here. We just needed to add it. There we go. Okay. So that's good. That makes sense. Let's add some other numbers in here. 5,000. Then let's say we paid this down a bit. 2,000. Now we go to the income statement. That's fine. Yep, balance sheet was here. Then we paid it off. Okay. Okay. That's good. So that's great. Let's do another set in March just to make sure everything's working. Or not March. Let's do like April. We have some more that we pay an account and up front, and then we pay off some on account in July. Okay, so we accrue 75. That makes sense. Here, balance sheet. This payable amount goes from 5 to 3,000 in April because it's going up 2,500 based on this amount we had expenses on account. Up. Then we pay off 2,000 in July, so it's going back down. And then that's hitting retained earnings because all we've basically accrued is $15,000 in expenses. So 15,000 would equal this 75 and this 75. So that makes sense. And cash flow statement, the income is here. We're adding back the amounts on account, and then we're reducing when those amounts are paid to get the actual cash flow in each period. Okay, magic. It's great. So we have the ability to enter sales, sales on account, receipts from sales on account. That's all going to affect receivables. We can enter contra revenue. We can enter cost of goods sold items, non-inventory, non-inventory paid on account, or accrued on account, paid on account. Then cost of goods sold inventory, inventory purchases on account. Now the difference, so cost of goods sold inventory, what is the difference between, let me just make sure I understand this. So this is inventory increase, inventory increase. Cost of goods inventory. This is how we actually account for when we sell something. We want to accrue, we want to say, okay, whatever we sold, this was the cost of what we sold. So this is going to be depleting inventory. I actually want to put that down here. So buy inventory, pay for it, accrue it, pay for it, reduce it in your operating income. Then we have other costs of goods sold, non-inventory, expense, accruing expense, paying the expense off. Then we have revenue, revenue on account, receipt of revenue on account. That's a very, very productive day compared to yesterday, and all this logic is all working. I'll probably start tomorrow off with the simulation that shows everything, like a bunch of different things happening from all these accounts, just to make sure it's all wrapping up, and then we'll continue on down the line um, with, we have debt, fixed asset stuff, but overall, this is going awesome. If you guys want to support me, you can check out more templates at smarthelping.com. If you look under the financial models, I've got over 100 financial models, templates, and tools. Lifetime access you can get for $9.99. That means anything I add in the future is included. Ask for a refresh anytime. I'll send you over the zip. I do a lot of pro forma stuff, a lot of SaaS business models, a lot of real estate financial models, cash flow, deal analyzers, um, joint venture waterfalls, a lot of startup models for all kinds of different industries, accounting tools, all sorts of stuff. So check it out. And normally I just stream Mondays and Tuesdays. I may stream tomorrow just because I'm kind of excited about this. Like, this is going pretty awesome. So I think I might actually stream tomorrow. We shall see. Until then, take it easy.